What if I told you that everything that you've been told about retirement tax planning is incomplete? That the strategy that most financial advisors use actually sets you up to pay more in taxes, not less. Today, I'm breaking down exactly what the wealthiest retirees do to keep more of their money in their own pocket. And before we go any further, I'm not a CPA, I'm not a tax advisor, so always consult with your tax professional before making any decisions. But what I'm about to share is something worth considering, and it's what a lot of my clients use when they're preparing for retirement income. My name is Samaya. I'm a certified financial fiduciary and founder of the Legacy Circle, where we work with retirees planning for retirement income and ways to avoid market risk and avoid paying more in taxes. So let's get into it. So here's how most people are taught to save for retirement. They save in their 401k or traditional IRA for years, and they just watch it grow tax deferred. Then they retire and start withdrawing for income. It sounds simple, right? The idea behind it is that you'll be in a lower tax bracket once you retire, so take the tax deduction today. But here's what that assumption doesn't account for. That strategy really only works if tax rates stay the same or go down, and if your retirement income is actually lower than what your working income was. But the reality is, once you retire, you'll have Social Security income coming in, maybe a pension, you're withdrawing from your investment, then RMDs kick in at 73 and force you to take out more income. And with all that income stacking on top of each other, most retirees find that they're either making the same amount of money or actually bringing in more money, which means they end up in the same tax bracket or even higher than when they were working. And nobody warned them about this, and nobody prepared them for it. Now, what happens when too much income stacks up in retirement? Well, when your retirement income crosses a certain threshold, multiple things start happening. First being that your Social Security income, more of it becomes taxable, up to 85%. And then your Medicare Part B premiums start increasing significantly, and this is called IRMAA, which stands for Income Related Monthly Adjusted Amount. It's basically a high income earner's worst nightmare, because every dollar that you're withdrawing for income is taxed as ordinary income. So you worked your whole life to build this big nest egg once you retire, but realistically, you're just paying more in taxes and giving more of it back to the government every time you withdraw. What are smart retirees doing differently so they keep more of their own money in their own pocket? Here's where the strategy shifts. The wealthiest retirees don't just diversify their portfolio between stocks and bonds, they diversify their tax exposure, meaning they have money in different tax buckets so they can control how much taxable income that they recognize each year. So let me break down what those three buckets actually look like. First bucket is taxable. This is going to be things like brokerage accounts, savings. It's taxed now and you're taxed on the growth. And the second bucket is tax deferred, meaning any money you put into these accounts, 401ks, traditional IRAs, goes in pre-tax. You don't pay the taxes today, but you will be taxed later. And then the third bucket is your tax-free bucket. This is Roth IRAs, Roth 401ks, certain life insurance policies. Once you pay the taxes today, you never pay taxes again. Your growth continues completely tax-free. Now, most people only have bucket number 2, the tax later bucket, and this is a problem. The goal is to intentionally build up that tax-free bucket before you retire, so you can choose where your income comes from, and it gives you more control over your tax bracket in retirement. Because if you need more income one year, well, you just pull from that tax-free bucket and it doesn't affect your taxable income. This gives you control that most retirees just simply don't have. And it's a conversation that your financial advisor should be having with you, but often isn't, because it requires proactive planning and not just investment management. So there are 2 common ways to build tax-free retirement money. First one is going to be through contributions. You just contribute yourself or through an employer with a Roth IRA, Roth 401k, let that build up. The money you put into it is already taxed, so it continues to grow for you for years to come tax-free. You never pay taxes again. Now, the second type is through Roth conversions, which is when you move pre-tax money to Roth dollars, tax-free dollars, strategically over time. You'll pay taxes on the amount that you convert in that year, but then it will continue to grow for you tax-free once you've already taken care of the taxes. Now, both of these strategies require planning, both have income and contribution limits, so you always want to consult with your CPA before making any of these moves. The most important thing to understand about Roth conversions is you have to be strategic about how much you convert each year. If you convert too much in one year, you can push yourself into a higher tax bracket, potentially triggering higher Medicare premiums. The sweet spot is really just converting enough that will keep you in that same tax bracket so you're not paying more in taxes. If you can get these Roth conversions done while you're in a lower income, maybe 5 to 10 years before RMDs begin, that's going to be ideal for your strategy. Now, here's where my specific expertise come in, and what a lot of my clients come to me for is using a fixed index annuity as a holding vehicle during the conversion window. Because a lot of people's concern in retirement is being too exposed to market risk. So how do we alleviate some of that market risk exposure? Is using a fixed index annuity as a safe money bucket, because the annuity now can do two things. It can protect your principal, providing a guaranteed floor, making sure that you never lose any money even if the market goes down. And while it's in the annuity, you can still do those Roth conversions just like you could in a Roth IRA in the market. Now, of course, this strategy with the fixed index annuity isn't for everyone. It depends on your full financial picture. But I find that once you get closer to retirement, you start getting concerned about market volatility and you're concerned about paying taxes later, using a safe money vehicle like the annuity to complete the conversions in is kind of two birds, one stone. Here's what I want you to walk away with. The bottom line is that having all your retirement money in pre-tax accounts is a risk that most people overlook until it's too late to do anything about it. Just like you wouldn't put all your money into one stock, you don't want to put all your money into one tax bucket either. Tax diversification is just as important as investment diversification. And that window to act and diversify your tax exposure is before you retire, not after. And of course, talk to your CPA about what a Roth conversion strategy could look like for you. Now, if you're within 5 years of retiring and you're also concerned about market volatility causing you to lose some of your money in retirement, and you want to see what completing a Roth conversion could look like inside a fixed index annuity for that safety factor, then use the link in the description to book your strategy call with me. And in that way, we can look at your full retirement income picture. I'll show you where the gaps are and how to get your tax exposure down while also protecting your principal. Talk soon.